The world's largest lender is making a move that could send shockwaves through the global financial system. A shift is happening quietly, but its effects could be anything but quiet. Japan, one of the biggest foreign holders of United States government debt, is no longer sitting on the sidelines. With more than $1 trillion in U.S. Treasury bonds, Japan has long been a pillar supporting the stability of America's debt market. But new reports reveal something unsettling. Japan is now rumored to be selling, and not small amounts, billions. When a creditor of that magnitude begins to unwind its position, the balance of global markets starts to tremble. This development matters profoundly because U.S. government debt is more than just an investment. It is the backbone of the global financial order. Countries rely on it as a safe store of value. Banks build their portfolios around it. Markets treat U.S. Treasuries as the ultimate risk-free asset, something that holds its value even when everything else becomes uncertain. But that stability depends on one thing: the biggest buyers must keep buying. Today, that long-standing support is weakening, and Japan's shift could trigger a chain reaction that most people are completely unprepared for. The core question emerging from this situation is shockingly simple yet deeply alarming. If one of the world's largest buyers steps back, who steps in to replace them? If demand drops, interest rates rise. When interest rates climb, borrowing becomes more difficult for governments, companies, and ordinary citizens. Harder borrowing conditions create stress on currencies, cause markets to wobble, and force governments to confront the possibility of reduced economic stability. So the real issue is not just that Japan may be selling U.S. debt. The real question, what happens next, is where the danger truly lies. In this video, we will break down exactly why Japan accumulated so much U.S. debt over the decades and what pressures might now be pushing it to walk away. You will see how such sales could drive up U.S. interest rates, weaken the dollar, and create new strains across global markets. But we will also explore the lesser-known side of the story: the financial stress building within Japan itself, the evolving strategy of its central bank, and the shifting balance of global power that is creating new risks many analysts hesitate to discuss openly. You will also learn how even slow, steady selling of U.S. Treasury holdings, far from headlines and breaking news, can quietly build pressure beneath the surface of the world economy. Step by step, tension can build until the system reaches a point where even a small shock might push it into instability. Many experts believe we may already be entering a long and unpredictable period, where old financial alliances weaken and nations become far more defensive about how they allocate their wealth. By the end of this video, you will understand how a seemingly technical decision made in Tokyo can influence mortgage rates in the United States, energy prices across Europe, and currency markets throughout Asia. Most people imagine financial danger as something loud and sudden like a crash. But sometimes the real danger grows quietly. It moves slowly, almost silently, until one day the world realizes the ground beneath it has been shifting all along. And right now, those quiet steps are getting louder. This situation is not only a story about economics. It is a story about global power, financial trust, and the possibility that the system we rely on may be entering a new and unpredictable phase. If you stay with us until the end, you will gain a complete understanding of why this moment could become one of the most important turning points in modern financial history. Welcome to our channel. If you appreciate deeper explanations, clear insights, and simple breakdowns of complex global events, make sure to subscribe. We have much more on the way, and you will not want to miss any of it. For many decades, foreign governments, central banks, and major institutional investors around the world have depended on U.S. government bonds as their safest place to store large amounts of capital. These bonds are backed by the United States government, widely seen as one of the most stable and reliable borrowers on Earth. During times of global uncertainty or whenever countries want to secure their reserves, money flows into U.S. Treasuries. It is a strategy that offers safety, liquidity, and a stable return, three qualities that are rare to find together on such a massive scale. Japan followed this same logic for years. As one of the world's largest exporters, Japan consistently generated massive trade surpluses, bringing in more money from global trade than it spent. Those surpluses needed a safe place to be stored, and U.S. government bonds became the ideal home. They provided stability, predictability, and extremely low risk. But for Japan, holding Treasuries was more than just a financial choice. It was a powerful tool for economic management. By purchasing large amounts of U.S. debt, Japan could help stabilize the value of the U.S. dollar, something that directly supported Japanese exports and helped preserve its competitive advantage in global markets. This strategy was not unique to Japan. Many major economies across Asia, the Middle East, and Europe built their financial foundations on U.S. Treasuries. The more they bought, the stronger the system became. But now, for the first time in decades, that foundation is showing cracks. For decades, a steady and reliable flow of foreign money into U.S. government bonds allowed the United States to borrow at remarkably low interest rates. This cheap borrowing was not a small advantage. It played a critical role in shaping America's economic strength. Low interest rates made it easier for the U.S. government to fund major programs, respond to crises, and maintain smooth financial operations. Just as importantly, these low borrowing costs helped fuel broader economic growth, allowing businesses and consumers to access credit at affordable rates. In many ways, foreign demand for U.S. Treasuries acted like a hidden engine powering the American economy. But this system depended entirely on trust. Foreign buyers trusted the United States to honor its obligations, to pay its debts on time, and to maintain a stable and reliable financial system. In return, the United States trusted that these foreign investors, especially large nations with big reserves, would continue purchasing its debt. This mutual confidence created one of the most important yet often overlooked financial relationships in modern history. Among these foreign buyers, Japan became one of the most crucial players. For many years, Japan regularly competed with China for the position of the world's largest foreign holder of U.S. government debt. Together, these two nations formed a powerful support structure under the U.S. bond market. Their massive purchases helped stabilize prices, keep yields low, and ensure that the dollar remained dominant in international trade and finance. For Japan, these holdings were not just financial investments, they were strategic assets. U.S. Treasuries provided Japan with a protective shield during times of uncertainty. When markets became unstable or when global shocks arose, Japan could rely on its stockpile of U.S. bonds as a source of stability. These bonds could be used as collateral, sold in emergencies, or kept as long-term reserves to maintain national financial security. This made them one of Japan's most valuable tools for managing economic risk. But now, signs of change are becoming impossible to ignore. In recent months, Japanese investors, including banks, insurance companies, pension funds, and major financial institutions, have been reducing their exposure to U.S. government bonds. These reductions have taken place quietly, carefully, and gradually, but they are significant. Japan has always been one of the most dependable buyers of U.S. debt, so even small shifts carry enormous meaning. When long-term investors like these begin to scale back their holdings, it signals a deeper change in strategy, one that global markets must pay attention to. Reports have shown consistent outflows, revealing that Japanese institutions are no longer increasing their treasury holdings the way they once did. Instead, they are selling portions of their portfolios, rebalancing exposures, and adjusting to new economic realities. These moves are not driven by impulse, they are calculated responses to changing global conditions. What makes this moment even more remarkable is the new tone coming from Tokyo. For the first time, Japanese officials have openly referred to their U.S. Treasury holdings as a card in trade discussions. This single word signals something profound. It suggests that Japan now views its vast holdings not only as financial reserves, but also as a form of leverage, an economic tool that could influence negotiations, shape diplomatic discussions, or protect national interests. Such language represents a major shift in mindset. A decade ago, foreign reserves were almost always treated strictly as financial instruments, not political ones. Today, Japan is openly acknowledging the strategic power of its treasury portfolio. Behind these developments lies a complex mixture of motivations. The first is global uncertainty. The world is facing rising geopolitical tensions, unstable markets, shifting alliances, and unpredictable economic cycles. In such an environment, investors everywhere have become more cautious. Japanese institutions, long known for their conservative approach, are responding accordingly. The second factor is rising U.S. bond yields. As yields increase, the price of existing bonds falls. For large investors holding massive positions, this creates the risk of substantial losses, rather than holding long-term bonds that may continue to lose value. Many Japanese institutions are choosing to trim their positions to protect their balance sheets. The third and perhaps most important factor lies at home. Japan is dealing with growing domestic financial pressures. Its population is aging rapidly, increasing the cost of pensions, healthcare, and social support programs. The government must spend more every year. At the same time, the Japanese yen has faced ongoing weakness, forcing the country to intervene periodically to stabilize its currency. All of these challenges require liquidity. Selling U.S. Treasuries provides Japan with the flexibility and funding it needs to manage these growing financial responsibilities. In addition, Japan's domestic bond market has begun offering slightly higher yields. While still low by global standards, even modest increases make Japanese government bonds more attractive than before. When domestic returns rise, Japan's financial institutions naturally redirect their investments inward, reducing their need for foreign bonds like U.S. Treasuries. Taken together, these forces explain why Japan, once one of the world's most consistent and loyal buyers of U.S. debt, is now stepping back. And although the selling is gradual, controlled, and carefully managed, its implications for the global financial system are enormous. Japan's shift away from U.S. Treasuries is also being driven by pressures emerging from within its own financial system, particularly its domestic bond market. For years, Japanese government bonds offered extremely low yields, which pushed institutions to look abroad for higher returns. But now, as yields inside Japan begin to rise, the equation is changing. Even slight increases in domestic returns reshape the investment landscape. Financial institutions that once relied heavily on foreign assets, especially U.S. Treasuries, are finding new opportunities at home. This growing appeal of domestic bonds creates a natural pull inward, encouraging Japanese investors to rebalance their portfolios and reduce dependence on foreign markets. This shift is happening at a time when global competition for safe assets is intensifying. Every major economy is trying to secure stable, low-risk investments while protecting itself from uncertainty. Japan, being one of the world's most cautious and strategic financial players, must weigh the value of foreign reserves against the need to support its own economy. Balancing these priorities is not easy. Maintaining a large stockpile of foreign debt requires resources, stability, and confidence, all of which are being challenged by changing economic conditions. These combined forces explain why Japanese investors are stepping back from a market they once dominated so confidently. But what happens when a major holder like Japan releases a significant amount of U.S. government bonds into the market? The mechanics of the bond system begin responding immediately. Bonds, like any other traded asset, follow the basic rules of supply and demand. When supply rises sharply and demand does not increase to match it, prices decline. A market that has become accustomed to steady, predictable buying suddenly becomes vulnerable. Even slow, controlled selling can introduce pressure because other investors observe the shift and begin adjusting their expectations. As more bonds become available, traders demand lower prices to compensate for the growing supply and the perceived increase in risk. These downward price movements are often the first signs of strain. The cracks do not appear through dramatic headlines or severe market collapses. They start quietly through subtle changes in pricing behavior. But once prices fall, yields rise automatically. A bond's yield is essentially the return investors earn for holding it. If the price goes down, the return must rise to attract new buyers. This is an automatic, mechanical response built into the structure of the bond market. The consequences of rising yields extend far beyond investors' portfolios. Higher yields mean the U.S. government must offer better returns in order to borrow money. Every bond auction becomes more costly. Funding national programs, supporting government initiatives, and refinancing existing debt all become more expensive. Even a small increase in yields can add billions of dollars to the government's long-term financial obligations. Over time, this quietly strains budgets, complicates fiscal planning, and puts pressure on lawmakers to either reduce spending or raise taxes. But the domino effect does not stop there. Rising yields spread throughout the broader financial system. Banks begin raising interest rates on loans because their own borrowing costs increase. Businesses that depend on credit for expansion, payroll, or daily operations suddenly face tighter lending conditions. A company planning to build a new facility may delay the project. A firm relying on borrowed capital might cut spending or reconsider hiring. Some businesses may even struggle to access credit altogether, especially smaller firms with less financial flexibility. And ordinary people feel the impact just as strongly. Mortgage rates rise, making homeownership more expensive. Car loans become costlier. Student loan interest increases. Credit card rates climb. Families start to feel the pressure as monthly payments swell and financial planning becomes more complicated. Even modest increases in borrowing costs can change consumer behavior. Households delay major purchases, reduce spending, or build savings rather than taking on new debt. These changes weaken consumer confidence and slow down economic activity, two critical components of a healthy economy. Financial markets react quickly to this new environment. Higher bond yields often trigger turbulence in stock markets, as investors reassess risk and rethink where to place their money. Stocks may become less attractive compared to safer, higher-yielding bonds, prompting investors to shift capital. This movement can create volatility across global markets. Currency fluctuations intensify as investors reposition themselves in response to changing interest rate expectations. Each adjustment creates another ripple of instability, adding strain to a global financial system that is already fragile. This chain reaction demonstrates how a single change in the bond market can spread across sectors, affecting every level of the economy, from the government to businesses to everyday households. What begins as a shift in Treasury holdings can cascade into broader economic consequences. Every adjustment, every movement, every signal contributes to a system that becomes increasingly sensitive to pressure. And when one of the world's largest holders of U.S. debt begins stepping back, even gradually, the effects are felt far beyond the borders of either country. As United States yields rise, global capital begins to move in new and unpredictable directions. Investors across the world are constantly scanning the financial landscape for the best balance between safety and return. When yields on U.S. government bonds suddenly become more attractive, a portion of global money naturally flows toward them. A higher return on what is considered the world's safest asset can look irresistible, especially for funds that must balance risk very carefully. But while some capital flows into U.S. bonds, other capital moves out of risk-heavy areas. Investors begin trimming positions in stocks, high-yield bonds, and investments in emerging markets. These assets, which thrive in periods of stability, become less appealing when rates rise and uncertainty spreads. Even a small shift in yields can trigger major reallocations within global portfolios. The result is a wave of movements, fast, large, and sometimes destabilizing, that ripple through financial systems reliant on consistent capital inflows. Rising yields also force investors to rethink their exposure to dollar-denominated assets. For some, higher yields may be a sign of opportunity. For others, they may be interpreted as a warning, an indication that deeper structural issues are emerging inside the U.S. economy. Investors who sense rising risk may diversify into assets priced in euros, yen, or even commodities like gold. These shifts add pressure to the dollar, which may weaken or experience sharp volatility as markets try to gauge the direction of global sentiment. A weaker or unstable dollar produces real, tangible consequences around the world. Currency values determine how nations price their goods, how central banks manage their reserves, and how inflation flows across borders. When the dollar fluctuates, global trade becomes more complicated. A softer dollar makes U.S. exports cheaper and imports more expensive. This sudden shift can disrupt long-planned trade relationships, profit margins, and supply chain strategies for countries that rely heavily on dollar-based pricing. Central banks holding large reserves of U.S. dollars must then reassess how to protect the value of their national wealth. Maintaining a strong reserve position becomes more difficult when the primary reserve currency is moving unpredictably. Some banks may choose to diversify by adding more gold or increasing holdings of other major currencies. Others may rebalance their portfolios towards stability. Each of these decisions, made by different countries for different reasons, influences currency markets worldwide, and each adds another layer of tension. As capital shifts and currencies swing, financial markets around the globe feel the pressure. Stock markets may experience spikes in volatility as investors rapidly adjust expectations and reposition their funds. Bond markets in Europe, Asia, and emerging economies often face rising yields of their own, as they must compete with stronger U.S. returns to attract investment. This competition can force borrowing costs higher even in countries that were previously stable. Emerging markets are among the most affected. These nations often depend heavily on foreign capital to finance government spending, business expansion, and infrastructure development. When U.S. yields rise, the flow of money into these regions can slow or even reverse. Currencies weaken, debt becomes more expensive to service, and refinancing becomes a challenge. Countries that rely on external borrowing may face higher costs, budget pressure, and if the situation deteriorates, potential funding gaps that threaten economic stability. The shockwaves do not end there. Nations closely tied to the dollar through their trade relationships or currency arrangements also feel the strain. When global capital moves suddenly, their financial systems must absorb the instability. Even strong, stable economies may encounter turbulence spreading through global banks, investment funds, and multinational corporations that operate across borders. These institutions feel the pressure when asset prices swing or when financing conditions tighten, creating risks that are difficult to manage. This chain reaction shows that rising U.S. yields are not merely numbers changing on a screen. They reshape how money moves, how currencies behave, and how markets respond worldwide. The effects are comprehensive, interconnected, and often underestimated. If more major holders begin reducing their U.S. Treasury positions at the same time, the stress on the global financial system could escalate rapidly. Japan is not alone in holding massive reserves. China, the United Kingdom, oil-exporting nations, and several emerging economies also possess large stores of U.S. government debt. If even a few of these players choose to sell in parallel or simply slow their purchases, the usual demand that stabilizes the U.S. bond market could weaken dramatically. A quick increase in available supply without an equivalent rise in buyers pushes bond prices down sharply. As prices fall, yields rise, forcing the U.S. government to borrow at even higher costs. This environment can weaken confidence in the dollar, intensify currency pressures, and spark rapid shifts in global exchange rates. When borrowing costs rise, credit conditions become tighter, banks grow more cautious, businesses postpone investments, consumers face higher interest rates on mortgages, car loans, and credit cards. What begins as a strategic adjustment by a foreign holder evolves into a broad financial squeeze that touches every corner of the economy. These reactions can destabilize markets that were already stretched thin by global uncertainty. When bond prices begin falling, certain investment funds, especially those that rely on strict risk profiles, may be forced to rebalance their portfolios. Some funds hold assets under rules requiring them to maintain specific ratios of safe versus risky investments. When prices drop and volatility rises, these automatic rules trigger asset sales, adding more supply into an already stressed market. This creates a chain reaction where selling leads to more selling and pressure intensifies with each step. In extreme cases, the market can enter a feedback loop. Rising yields translate into higher borrowing costs, which slow economic activity. Slower growth makes investors more cautious, pushing them to sell assets they consider vulnerable. This additional selling further depresses prices, pushing yields even higher and amplifying financial tension. What begins as a mild adjustment can evolve into a cycle that reinforces itself at every stage, an economic echo that builds in strength, drawing more institutions into defensive behavior. In today's interconnected world, even moderate disruptions can spread rapidly. Many countries are already carrying heavy debt burdens, struggling with weak currencies and experiencing fragile economic recoveries. A shock in the bond market can quickly ripple through stock exchanges, credit systems, global trade networks, and currency markets. Suddenly, multiple economies that were hanging on by a thread may find themselves slipping into deeper instability. The financial system becomes vulnerable not because of one dramatic event, but because smaller stresses link together across different markets. Large holders of U.S. debt rarely dump their assets all at once. Doing so would damage the value of their own holdings. Instead, sales typically unfold in stages, slow, controlled, and spread across weeks or even months. Institutions plan their transactions carefully, diversifying across maturities, auctions, and time windows to reduce market disruption. Even when pressure is rising, major players act strategically, knowing that a sudden liquidation could trigger a crisis that nobody can fully control. This measured approach gives global markets breathing room, allowing them to absorb new supply gradually. Another stabilizing factor is the diversity of the global investor base. When one major group pulls back, another often steps forward to seize opportunity. Private investors, sovereign wealth funds, pension funds, insurance companies, and central banks from smaller economies may increase their purchases when yields rise. For them, higher returns on U.S. government bonds look attractive, especially if they believe volatility will eventually settle. Some nations use periods of market stress to rebalance their reserves, buying treasuries at discounted prices and strengthening their long-term financial position. This mix of buyers helps maintain demand even when traditional giants like Japan or China reduce their holdings. The sheer size of the U.S. Treasury market also acts as a powerful buffer. It is one of the deepest, most liquid financial markets on Earth, with constant buying and selling activity from banks, hedge funds, corporations, and governments. The market is designed to handle massive daily trading volumes. Because of this depth, even several weeks of heavy selling do not necessarily lead to collapse. Liquidity acts like shock absorbers on a vehicle, reducing the impact of bumps and sudden changes. Governments and central banks also possess tools to support stability when needed. They can influence interest rates, initiate bond buying programs, or inject liquidity to ease stress. Coordinated efforts between major central banks such as the Federal Reserve, the Bank of Japan, and the European Central Bank can calm global markets almost instantly. These institutions can also use targeted announcements or communication strategies to reassure investors, signaling that they are ready to intervene if necessary. Fiscal measures, foreign exchange interventions, and emergency lending programs form additional layers of protection that keep the system functioning even during turbulent periods. However, despite these protective measures, one of the clearest and earliest warning signs of growing pressure is a sudden spike in the yield of the 10-year U.S. Treasury bond. This single instrument acts as a global benchmark, influencing borrowing costs for governments, corporations, and consumers across the world. When the yield starts climbing rapidly, it signals that investors are demanding higher returns to compensate for perceived risk. A sharp rise often reflects stress, uncertainty, or large-scale selling by major holders. What makes the 10-year yield so important is its influence on everyday financial life. Even a small move upward can raise mortgage rates, increase corporate borrowing costs, and shift investment flows across continents. When yields rise suddenly, banks, hedge funds, and central banks pay close attention. It often serves as an early alert that something deeper may be changing within the global financial system. If the spike is rapid or sustained, it becomes a signal that pressure is building beneath the surface, and that markets may be preparing for a more volatile period ahead. Another important signal comes from movements in the value of the United States dollar. The dollar sits at the center of global finance, so when its value swings sharply against major currencies, it tells us that investors around the world are repositioning themselves. A rapid drop in the dollar often suggests that confidence in U.S. assets is weakening. Investors may be pulling money out of dollar-denominated investments, seeking alternatives in other currencies, commodities, or even emerging markets. Conversely, a sudden rise in the dollar can indicate that global money is rushing into safety, with investors seeking protection during periods of uncertainty. Either scenario, whether a weakening or strengthening dollar, creates complications for global trade. Import and export prices adjust quickly when currency values shift. A weaker dollar makes American exports cheaper but raises the cost of imported goods. A stronger dollar does the opposite, hurting U.S. manufacturers while lowering import prices for American consumers. For trading partners, especially export-driven economies, these shifts can disrupt supply chains, alter profit margins, and force companies to adjust production or pricing strategies on short notice. Such changes also force central banks around the world to react. Countries with currencies tied closely to the dollar must decide whether to intervene in their foreign exchange markets, adjust interest rates, or allow their currencies to move freely. A sharp change in the dollar's value can also influence inflation. For example, when the dollar weakens, imported goods become more expensive for Americans, potentially raising inflation. When the dollar strengthens, inflation may ease in the U.S. but rise elsewhere as their local currencies lose purchasing power against the dollar. Stock markets are equally sensitive to changes in the bond market and currency environment. When U.S. Treasury yields spike, equity markets often fall. Higher yields increase borrowing costs for companies, reduce profit expectations, and make stocks less attractive compared to safer assets like government bonds. As yields rise, large institutional investors, including hedge funds, pension funds, and sovereign wealth funds, may rebalance their portfolios. This often means shifting money out of stocks and into bonds, adding further pressure on equity markets. Volatility spreads quickly, often moving from the United States to Europe, Asia, and emerging markets within hours. Different sectors react differently to these movements. Technology companies, which rely heavily on future growth and often depend on cheap borrowing, can suffer sharp declines when yields rise. The banking sector may initially benefit from higher interest rates, but broader economic stress can still weigh on financial institutions. Energy, manufacturing, and transportation sectors can see volatility due to shifting global demand, currency risk, and changes in borrowing conditions. Even smaller companies with limited financial buffers can feel immediate strain. Foreign holdings data provides another essential warning indicator. When major creditors begin reducing their U.S. Treasury positions faster than usual, it suggests a shift in global confidence. Consistent declines in holdings by Japan, China, oil-exporting nations, and major Asian economies often signal deeper changes in how these countries view U.S. debt Policymakers, investors, and analysts monitor these shifts closely because they reveal global sentiment about the long-term stability of the U.S. financial system. A slowdown in foreign demand for treasuries can have far-reaching effects, influencing interest rates, currency movements, and global economic stability. Governments and central banks respond quickly when these signals appear. To stabilize currency movements, they may raise or lower interest rates. To support credit markets, they may buy bonds or inject liquidity into the banking system. Sometimes, these financial actions are paired with diplomatic discussions, trade statements, or policy announcements meant to calm investor fears. Even carefully crafted communication from officials, often called forward guidance, can significantly influence markets by shaping expectations and slowing panic-driven behavior. Despite these tools, the financial system that has kept global markets stable for decades appears to be entering a period of transformation. Japan and other major holders of U.S. debt are signaling shifts that could have profound consequences. If these countries begin moving away from U.S. bonds in a sustained and coordinated way, the effects will not be confined to the Treasury market. Currency values could become more volatile. Stock markets could experience sustained turbulence. Credit conditions could tighten globally, and everyday people around the world could feel the impact through rising mortgage rates, higher loan costs, and increased financial uncertainty.